Good morning and welcome to Bulls, Bears, and the Bell Weekend Edition.
Good morning. It's great to be diving deep again, especially right now, because for you, the listener paying close attention, we are really standing at, I think, one of the most pivotal junctures of the entire year.
It really feels that way, doesn't it? The market's just wrapped up this, record-setting period.
Absolutely. The S&P 500 pushed past that really impressive 6,600 milestone.
Incredible number.
It is. And it was fueled by a mix of things, right?
Yeah.
You had that technical momentum carrying it forward. You had the just pervasive enthusiasm around anything AI-related.
Still going strong.
Still going very strong. And then, crucially, you had this brand new commitment, or at least the appearance of one, to accommodative policy coming straight from the Federal Reserve.
Okay, so that's the shiny surface, right? The records, the AI hype, the Fed finally cutting rates. That's maybe the euphoria we saw playing out last week.
Pretty much, yeah.
But our mission today, for you listening, is really to peel back that layer and analyze the fundamental conflict that's brewing just beneath that very bullish surface.
Yeah.
Because we are heading into, what feels like a serious collision course this week.
That's a good way to put it, a collision course.
On one side, you've got this powerful tailwind from the Fed's recent dovish pivot. That first long-awaited rate cut of 2025, everyone was waiting for it.
Everyone. And they finally delivered. But on the other side, you've got this just relentless flood, almost a gauntlet, you could say, of high-impact economic data scheduled for release over the next 5 days. That's September 29th through October 3rd. It's packed.
It really is. And the way this conflict resolves, the outcome of this data versus Fed dynamic, it's everything.
It really is everything, because the result isn't just going to dictate the near-term path for asset prices,
Right.
stocks, bonds, the dollar, gold, all of it.
Right.
But it's also going to determine whether the Fed's move last week, that insurance cut, was actually justified. Was it the right call based on the real economy?
So our core thesis for this deep dive is essentially this. The market's current momentum, which, as we noted, feels quite narrow and maybe a bit fragile, is walking directly into this high-stakes data gauntlet. A real trial by fire.
And the climax of that gauntlet, the main event everyone's laser focused on, is, of course, the critical September non-farm payrolls report coming out this Friday. That's the big one.
That is the big one. So the stance we need to take, and what you should probably consider, is one of, let's say, cautious optimism. We have to respect the technical trend. The upward momentum is there.
You can't ignore the price action.
You can't. But we absolutely must balance that optimism against the looming shadow of volatility that this incredibly dense data calendar is almost guaranteed to inject into the market.
Yeah, October's reputation for volatility isn't exactly unearned.
Not at all. So let's start by really dissecting the biggest news from last week, that macro shockwave delivered by the Federal Reserve. We need to understand the context behind their decision before we look ahead.
Right. The Federal Open Market Committee, the FOMC meeting, it was, without question, the dominant event driving markets last week. No contest.
All eyes were on Powell.
Completely.
Yeah.
And for the first time this year, after 8 long months of holding rates steady, maintaining that tight stance.
Holding the line.
Holding the line, exactly. They finally executed a 25 basis point rate cut. That moves the federal funds target range down to 4.00%, 4.25%.
Okay, so the cut itself, 25 basis points, that was largely expected, right? The market had pretty much priced that in.
It was, yeah. Very high probability baked in.
Yeah.
But the framing of the cut, the language they used,
Yeah.
that was, I'd almost say revolutionary, or at least significantly different from past easing cycles.
And that framing is precisely what seems to have caused so much confusion, maybe even some skepticism among institutional investors and analysts.
A lot of skepticism.
Because policymakers, they went out of their way, it seemed, to aggressively characterize this move not as a response to current weakness, but as a risk management step, or the phrase that caught everyone's attention, an insurance cut.
That's the moniker, yeah. The insurance cut.
But wait a second. If they explicitly stated, as Powell seemed to, that they were not reacting to a clear present recession signal.
Right. He was quite clear on that.
Then isn't calling it an insurance cut just a highly polished rebranding of maybe a little bit of panic, or at least significant worry? Why cut at all if the current data, excluding those revisions we'll get to, was still holding up reasonably well? Why not just hold steady?
That is the absolute core of the skepticism we need to apply here. You've hit the nail on the head. They are trying to walk an incredibly fine line.
A tightrope.
A complete tightrope. Chairman Powell, in his press conference, he really emphasized the complexity, didn't he? He warned there's, quote, no risk-free path for monetary policy right now.
Which sounds reasonable, but also a bit like covering their bases.
It does, and essentially the Fed is trying to balance two fundamentally contradictory forces, it seems. On one hand, they readily admit that inflation, while it's come down, remains somewhat elevated.
So mission not accomplished on inflation.
Not fully accomplished, no. They haven't spiked the football there. But on the other hand, they felt they had to act preemptively. They needed to safeguard the ongoing economic expansion against what they perceived as rising downside risks, particularly, and this is key, in the labor market picture after those historical revisions.
So it's about avoiding a mistake.
Exactly. They desperately want to avoid a policy error of over-tightening, of choking off the expansion unnecessarily because they misread the underlying strength, especially in light of that revised jobs data. They're insuring against that specific risk.
Okay, that desire to avoid a policy error, to insure against accidentally causing a downturn, that brings us immediately to the rather contradictory signals that came out alongside the cut in the summary of economic projections, the SEPI, or the dot plot, as everyone calls it.
Right.
Because that added another massive layer of complexity and really seemed to confuse the bond market quite significantly in the days following the announcement.
Oh, it was almost a paradoxical release. A head-scratcher for many. Because on one hand, the committee's median projection, the famous dots.
Where each official puts their forecast.
Exactly. That median signaled a notably more dovish rate path than what they had projected back in June. It suggested the possibility of, get this, 2 additional 25 basis point cuts before the end of this year, 2025.
2 more cuts this year, wow.
And maybe even 1 more cut penciled in for 2026. So that's a clear, institutionalized easing bias being signaled. They're basically telling us, we intend to cut more, likely sooner rather than later.
Okay, that sounds straightforwardly dovish. Lower rates are coming. But here's the paradox, the part that had bond traders, as you said, scratching their heads.
Yes.
These very dovish rate projections, which logically signal a need for more monetary support because maybe the economy is weakening.
Right, that's the usual interpretation.
They were released alongside modest upward revisions to the committee's own economic growth forecasts for the near term.
Exactly. And specifically, their projections for the trajectory of the unemployment rate were actually nudged slightly lower, implying a tighter job market than previously thought, and some of their core PCE inflation outlooks were, well, stabilized, or even slightly higher in the out years. It implied a healthier, maybe even slightly stronger underlying economy.
So let me get this straight. The Fed is telling us, through their forecasts, that the economy is projected to be a bit stronger than they thought 3 months ago.
That's what the numbers suggested, yes.
But somehow, this stronger economy needs more monetary support through faster and potentially deeper rate cuts. What gives? How do those two things reconcile?
Well, the linchpin that holds this seemingly contradictory message together, is tied directly to their primary justification for the cut itself. The labor market reassessment.
Ah, okay. Those historical data revisions.
Precisely. This is the crucial aha moment for anyone trying to really understand this pivot. The Fed didn't act primarily based on the most recent, say, August or September forward-looking data points. They acted because of revised historical data, specifically the benchmark revisions to payrolls, which fundamentally reset their perception of the economy's underlying momentum over the last year or two.
Let's definitely spend some time on those revisions then, because if they're the linchpin, as you say, of this entire dovish argument, we need to understand exactly what changed.
Absolutely critical. And this wasn't just a standard monthly jobs report miss or beat, the usual noise.
No, this was structural.
This was structural. The Bureau of Labor Statistics, the BLS, delivered these preliminary downward benchmark revisions. These aren't small tweaks. They are deep dive changes based on more comprehensive data, like unemployment insurance tax records. They give a much more accurate picture of the job market over a longer period.
So what did they find?
Well, first, back earlier this year, we got the preliminary adjustment for the 12 months ending in March 2024. That showed payrolls had been overstated by a significant 818,000 jobs during that period.
Okay, 818,000 is a big number. That already lowered the baseline.
It did. But then the Fed, in justifying this cut, highlighted preliminary BLS analysis suggesting an even larger overstatement, potentially around 911,000 jobs for the period through March 2025.
Whoa, so nearly 1 million jobs over the more recent period as well.
Potentially, yes. We're talking about a cumulative potential overstatement well north of perhaps 1.5 million jobs over roughly 2 years. This wasn't a minor calibration. It was a wholesale rewrite of the perceived strength of U.S. job growth during a critical period when the Fed was tightening policy.
So basically almost a million jobs, maybe more cumulatively, that everyone, the market, the Fed, economists thought existed, simply weren't actually there, according to the more accurate revised data.
That's the implication, yes.
That doesn't just slightly reduce the perceived economic momentum. It fundamentally changes the entire narrative about whether the economy was genuinely overheating back in 2023 and early 2024 when inflation was peaking.
Exactly right. These revisions completely reset the labor market narrative for the Fed. Suddenly, the high-frequency softness we've been seeing in some of the monthly reports, like that really meager August job gain of only 22,000 net positions.
Which looked like a weird outlier at the time.
Exactly. It looked like a potential statistical blip and anomaly. But viewed through the lens of these massive downward historical revisions, that 22,000 gain suddenly looked like clear confirmation of a pre-existing, structurally slowing trend in job creation that the initial data had completely missed.
So the Fed wasn't reacting to the 22K number itself, but saw it as proof the revisions were showing the true, weaker underlying trend.
Precisely. The Fed acted because they now believe the true underlying momentum of the labor market had already largely evaporated months ago, making the economy highly vulnerable to an unnecessary policy-induced slowdown or even recession if they didn't cut rates immediately. They felt they were catching up to a reality that the revised historical data finally revealed.
Okay, that makes the insurance framing make a bit more sense. They're insuring against a slowdown that they now believe was already underway but hidden by faulty data.
That seems to be the most charitable and logical interpretation of their actions and communication, yes.
Now, while the U.S. was making the significant dovish pivot based on these domestic data revisions, it's fascinating to see the policy divergence happening globally. This wasn't a coordinated global easing move at all.
Not even close. In fact, you had some major central banks moving in the complete opposite direction. The Bank of Japan, for instance, delivered a real surprise.
What did they do?
They adopted a surprisingly hawkish tone in their communications. BOJ officials explicitly flagged the potential for future rate hikes, which is huge for Japan, coming out of decades of zero or negative rates.
Hikes in Japan, that's a sea change.
A massive potential sea change. And they also signaled they might finally start tapering their enormous holdings of exchange-traded funds, ETFs, which they've used for years as a tool to directly support their stock market.
So less support for stocks and potentially higher rates. How did the market react?
Immediately. The commentary sent the 2-year Japanese government bond, the JGB, yield surging. It hit its highest level since way back in 2008.
Wow.
It was a dramatic shift, and it strongly suggests that Japan might finally be preparing to exit its long era of deflationary monetary policies. That has huge implications for global capital flows if Japanese money starts seeking higher returns at home.
So you have the Fed cutting, the BOJ sounding hawkish, two of the world's most critical central banks pulling policy levers in completely opposite directions. What about elsewhere?
Elsewhere, it was more aligned with the Fed, generally. We saw the Bank of Canada deliver a rate cut, as did Norges Bank, the central bank of Norway.
And their reasoning?
Primarily reflecting pressure from softening economic growth in their respective regions. Canada's economy has been showing clearer signs of cooling, and Norway is obviously sensitive to shifts in energy prices and European demand. So more localized concerns driving those cuts.
Okay, so Fed, BOJ, Norges Bank easing, BOJ tightening its tone. Now, the dollar. Usually a Fed rate cut is bad news for the dollar, right? Lower yield appeal?
Typically, yes. All else being equal, low rates make a currency less attractive to hold.
But that's not really what happened last week, was it?
Not sustainably, no. The dollar did dip initially, right after the Fed announcement, as you'd expect, but it demonstrated remarkable resilience and quickly rebounded in the following days, erasing those losses and even pushing higher against some currencies.
Why? What's keeping the dollar so strong even when the Fed is cutting?
It comes down to two powerful, interconnected factors that are really driving global capital flows right now, especially influencing the carry trade.
Okay, what are they?
First is the simple yield differential. Even with the Fed cutting to a 4.25% range, U.S. interest rates, particularly at the short end of the curve, remain significantly more attractive compared to the near zero or still negative rates prevalent in major economies like the Eurozone and especially Japan.
So you still get paid more to hold dollars?
Considerably more. On a relative basis, that carry appeal is still very strong. Second, and perhaps even more importantly right now, is the prevailing perception of continued U.S. economic outperformance.
The U.S. exceptionalism narrative?
Exactly. Despite the Fed's cut and the job revisions, the narrative persists that the U.S. economy is fundamentally more resilient, more dynamic, and growing faster than Europe or Japan. This perception acts as a powerful safe haven magnet, pulling capital into the U.S., especially during times of global uncertainty or when other major economies look weaker.
So higher relative yields, plus the belief that the U.S. economy is the cleanest shirt in the dirty laundry, so to speak.
That's a very common way to phrase it, yes.
Hmm.
Those two factors are overwhelming the typical negative impact of a single rate cut, at least for now.
Okay, but that dynamic itself, the strong dollar persisting despite the Fed starting to cut rates, feels like one of those core tensions you mentioned earlier. It feels unsustainable.
It absolutely is. Capital cannot logically, over the long term, simultaneously believe that the Federal Reserve needs to cut rates because the economy is weakening or at risk, and that the U.S. economy is so exceptionally strong compared to the rest of the denaturation world that the dollar deserves a premium. Those two ideas conflict.
Something has to give.
Something has to give, and that's precisely why this upcoming week's data is so critical. It will directly challenge one side or the other of that narrative. The data will force the market to start resolving that tension.
Okay, that's a perfect setup. We understand the Fed's move, the controversial justification, the global divergence, and this underlying tension in the dollar. Let's pivot now to how the markets actually processed all this complex, sometimes contradictory information in the last 5 trading days, September 22nd to 26th. So, looking at the scoreboard for last week, on the surface, the equity market looked fantastic, didn't it?
Absolutely. If you just looked at the headline indices, it was a banner week, record-setting, as we said. The S&P 500 closed clearly above 6,600.
And the NASDAQ?
The NASDAQ, heavily driven by those mega-cap tech stocks, also hit new all-time highs. So from that perspective, the bulls were firmly in control.
But you used the word fragile earlier when describing this rally. This narrow march higher seems to be the defining feature and maybe the biggest worry about this current market structure.
It absolutely is the defining feature, and it should be a point of caution for investors. The drivers of this rally remain remarkably consistent and remarkably concentrated.
Still the same story?
Still, largely the same story. It's driven by that intense concentration in a handful of mega-cap technology stocks, fueled by that relentless AI narrative that assigns almost infinite future growth potential to these companies.
We saw specific examples last week driving those gains, right?
Good. Huge moves in individual names. Intel, for example, soared. Why? Reports surfaced of a massive potential $5 billion strategic investment coming from NVIDIA.
NVIDIA investing in Intel. What's the angle there?
The idea is NVIDIA helping to bolster Intel's foundry business, their chip manufacturing capacity, potentially securing future supply or influencing technology development. It's a sign of the incredible capital flooding into anything touching advanced semiconductor manufacturing.
Okay, and Oracle.
Oracle also saw significant gains. News broke that they're in advanced talks with Meta Platforms, Facebook's parent company, about a potentially very large cloud infrastructure deal. Again, AI-related demand driving huge contracts for cloud providers.
So it's these tech giants, fueled by AI spending and deals, pulling the indices higher. But you called this leadership concentration a double-edged sword. Why?
Because while it provides powerful upside momentum when sentiment is positive, it also makes the entire market extremely vulnerable. If anything happens to challenge the narrative around these specific mega-cap names, maybe regulatory concerns, maybe a shift in AI spending, or critically, a sharp rise in interest rates, which hurts growth stock valuations, the whole market could correct sharply because there's no broad base of support underneath.
And you used the word fragile. I was actually talking to a portfolio manager earlier this week who dismissed the recent strength in small-cap stocks, calling it a complete head fake. What makes you still think this rally remains fundamentally narrow, even with the S&P hitting new highs? Is he right?
Well, head fake might be strong, but the underlying point about narrowness is absolutely valid. Because if you look beneath those glittering headline indices, the market breadth, the number of stocks participating in the advance, is persistently, worryingly thin.
How can we see that?
Look at the sector performance. Defensive sectors, the ones investors usually buy when they're worried about the economy, are lagging badly. Consumer staples, the XLP ETF.
Things like Procter & Gamble, Coca-Cola.
Exactly, those kinds of companies. And healthcare, the XLV ETF. Both were notable laggards last week. In fact, several prominent stocks within those sectors actually hit fresh 52-week lows.
Lows? while the S&P is at highs.
Exactly. And both of those major defensive sectors remain negative for the year to date. That's a huge divergence. It tells you capital is not committing broadly across the market. It's hiding, or rather chasing performance, in those few known winners in technology and communication services.
Because those companies promise growth that seems somewhat independent of the overall economic cycle, tied more to specific tech trends like AI.
Precisely. The market is betting heavily that these tech giants can continue to deliver strong earnings growth even if the broader economy slows down. That reliance on a few specific narratives makes the rally inherently fragile and vulnerable to shifts in those narratives, or, importantly, shifts in interest rate expectations which disproportionately impact high-growth valuations.
Okay, that's a crucial point about the fragility. That being said, we did see at least one potentially promising signal from a different part of the market last week, small cap stocks.
Yes, that was an interesting development.
The Russell 2000 index, which tracks smaller U.S. companies, actually outpaced the S&P 500 and the Nasdaq during the week of the Fed cut. What does that potentially signify?
That specific outperformance is almost certainly a direct reaction to the Fed's rate cut and the immediate, though perhaps temporary, drop in Treasury yields that followed.
Why are small caps so sensitive to rates?
Small cap companies tend to be more domestically focused, so they're less exposed to global slowdowns maybe. More importantly, they often carry heavier debt loads relative to their size compared to the mega caps swimming in cash.
So lower borrowing costs help them more?
Disproportionately so, yes. Easier monetary policy, lower borrowing costs, it directly helps their bottom line and makes their future investment plans look more viable. So the market reaction made sense. The Fed cuts, small caps rally.
And I sense a but coming. Is it sustainable? Can small caps continue to lead?
That is the vital caveat. The sustainability of that small cap rally, whether it's more than just a short-term reaction to the Fed, depends entirely on what the incoming economic data tells us this week.
How so?
For small caps to truly take leadership and sustain a rally, you need more than just slightly lower interest rates.
Okay.
You need confirmation that the domestic U.S. economy is not just avoiding a sharp downturn, but is actually poised for a re-acceleration.
They need real growth, not just cheaper debt.
Exactly. If this week's data, particularly NFP, and the ISM numbers points towards continued slowing or stagnation in the U.S. economy, then those cheaper rates won't be enough to save small caps from facing earnings pressure and waning investor enthusiasm. Their fate is much more closely tied to the domestic cycle than the tech giants.
So small caps are a key tell for domestic economic confidence. Got it. Now let's shift gears to the fixed income market, the bond market, because this is really where the market's skepticism towards the Fed's dovish narrative truly manifested itself, wasn't it?
Or absolutely. The bond market's reaction was fascinating and frankly offered a genuinely contradictory signal almost immediately following that dovish pivot from the Fed.
What happened? Walk us through the sequence.
Okay, so initially, right after the FOMC announcement on Wednesday afternoon, everything went exactly as the monetary policy textbooks would predict.
Yields down, prices up.
Precisely. Yields fell sharply all across the Treasury curve. Short-term yields, long-term yields, they all dropped significantly as bond prices jumped. The market was immediately pricing in that easier policy path the Fed had signaled.
Okay, standard reaction, but how long did that last?
Less than 24 hours, really.
Yeah.
That initial dovish euphoria in the bond market was remarkably short-lived. Starting on Thursday and accelerating into Friday, Treasury yields reversed course sharply and climbed significantly higher.
How high did they get?
The benchmark 10-year Treasury yield, which had dipped well below 4%, climbed back up to close the week, around 4.14%. And the 2-year Treasury yield, which is much more sensitive to near-term Fed policy expectations.
Right, that one really reflects rate hike cut odds.
Exactly. That bounced hard from its lows and closed the week near 3.58%. So a very significant reversal.
What does that reversal tell us? What were the bond traders thinking?
It essentially tells us that the bond market, while acknowledging the cut the Fed delivered, immediately started pushing back against the future path the Fed seemed to lay out. The bond traders effectively looked at the Fed's justification, looked at the dot plot, and said, okay, thanks for the insurance cut today. Maybe you had to do it because of those revisions, but we're not convinced you're going to deliver those 2 extra cuts this year unless the economy really falls off a cliff.
So they saw the cut as maybe a one and done, or at least they needed more proof before pricing in the full dovish path. Kind of like, thanks for the clarity on the past, now back to the reality of the incoming data.
That's a perfect way to capture this sentiment, I think. They accepted the rationale for this cut based on the historical revisions, but their conviction about future cuts weakened considerably almost immediately.
What specific data points came out later in the week that might have fueled that bond market pullback, that faster rise in yields?
It was primarily a combination of data releases on Thursday and Friday that seemed to contradict that cooling labor market, slowing economy narrative that underpinned the Fed's justification.
Such as?
Well, we got robust personal spending figures for August. That suggested the U.S. consumer, the main engine of the economy, was still quite healthy and spending freely, not pulling back sharply.
Consumer still strong. Okay. What else?
And perhaps even more significantly, we got the final revision to the second quarter gross domestic product GDP estimate, and it was revised upwards slightly.
Upward. So the economy was actually stronger in Q2 than we previously thought.
Exactly, reinforcing the idea that the immediate economic past, the period leading right up to the Fed's cut, was actually stronger, not weaker, than the earlier data had indicated.
Okay, so strong consumer spending, upward GDP revision. That definitely clashes with the idea that the Fed needed to urgently cut rates due to imminent weakness.
It certainly complicates the narrative, and bond traders reacted logically. They saw this incoming data, weighted against the Fed's revised historical view, and decided the odds of further imminent cuts weren't as high as the Fed's own dot plot suggested.
Did we see that skepticism reflected in market pricing for future meetings?
We did. The implied probability of another 25 basis point cut happening at the October FOMC meeting, which had jumped to over 90% right after the announcement.
So almost a certainty priced in?
Almost a lock. That probability slipped back down to around 87% by the end of the week. It's still high, suggesting the market thinks another cut is more likely than not eventually, but that conviction definitely eroded. The bond market is essentially saying, show us the weaker data first, then we'll believe in more cuts.
Fascinating. The bond market is acting as the more sober judge here, perhaps. Now, this inherent confusion, this tension between the Fed's dovish signal and the bond market's skepticism, leads us directly to probably the strangest cross-asset dynamic we saw last week.
Ah, yes. You must be talking about the gold-dollar contradiction.
Exactly. It was really unusual. Normally, gold and the U.S. dollar move in opposite directions, right? They have a strong inverse correlation.
Almost always. A stronger dollar typically means lower gold prices, as gold is priced in dollars, and vice versa. A weaker dollar, often associated with easing monetary policy or inflation fears, tends to boost gold.
But last week, that relationship completely broke down. Both gold and the dollar staged powerful, simultaneous rallies. How does that even happen?
It reflects profound confusion and tension among institutional investors about what the core economic narrative actually is right now. They're hedging bets in opposite directions simultaneously.
Let's break it down. What drove the gold rally?
Precious metals surged across the board. Gold pushed decisively above $3,650 an ounce, a really significant level. And silver had an even more dramatic breakout, surging above $43 an ounce to hit a 14-year high.
14 years for silver. Wow, what was fueling that?
It was almost entirely fueled by the sharp drop in real yields. That's nominal Treasury yields minus inflation expectations, that occurred immediately after the Fed's dovish announcement. Lower real yields make non-yielding assets like gold and silver much more attractive to hold.
So the gold market was reacting directly to the Fed's dovish signal.
Exactly. The gold market seemed to be fully buying into the idea of sustained, maybe even aggressive, dovish policy from the Fed going forward. Investors were likely buying gold as a hedge against potential future currency debasement if the Fed keeps cutting, or as a hedge against inflation risk if the Fed lets inflation run a bit hotter to support growth. It was pricing in a very dovish Fed future.
Okay, gold prices in a dovish Fed. But at the exact same time as we discussed, the U.S. dollar index also rallied strongly, particularly later in the week.
Right, and a rallying dollar, by definition, is pricing in the opposite scenario in many ways. A strong dollar typically reflects expectations of continued U.S. economic outperformance relative to the rest of the world. It reflects capital flowing into the U.S., seeking higher returns or safety. It prices in tighter relative monetary policy, or at least less aggressive easing compared to other central banks.
So the dollar is essentially screaming, the U.S. economy is the best investment destination. It's strong. Yields are attractive.
Precisely. While simultaneously gold is screaming, U.S. monetary policy is becoming deeply inflationary or debasing. Real yields are falling. Protect yourself.
Those two narratives are fundamentally incompatible over anything but the very short term.
Absolutely. Capital cannot sustainably flow into both the safe haven dollar, betting on U.S. strength, and safe haven gold, betting against the dollar or on falling real yields, simultaneously, and expect both trends to continue indefinitely. It's a sign of extreme market uncertainty and positioning ahead of clarifying data.
This tension must be resolved, and you think the incoming data this week is the catalyst.
It has to be. One of those narratives is going to be proven more right than the other by the data flow. And the non-farm payrolls report, being the ultimate monthly arbiter of U.S. labor market health and wage pressures, is the perfect high-impact catalyst to force that resolution. It will likely cause a significant move in either the dollar or gold, or both, as the market coalesces around a more unified narrative.
Okay, that's a critical dynamic to watch this week, the resolution of the gold-dollar paradox. Before we move on to the data gauntlet itself, let's quickly touch on the digital asset space. Bitcoin had a wild ride too, didn't it? It seemed to decouple a bit from the broader tech rally later in the week.
Yeah, massive volatility in crypto, and a stark reminder of the significant leverage still present in that ecosystem.
What happened with Bitcoin?
Well, initially, Bitcoin rallied hard alongside other risk assets after the Fed cut. It benefited from the general risk-on mood and also the ongoing tailwind from strong institutional ETF inflows we've seen this year. It pushed up aggressively, trading towards $117,000 at one point.
So it looked like it was joining the party.
It did, briefly. But that strength was very quickly and brutally erased, particularly over the weekend. A sharp sell-off hit the market.
What triggered the sell-off? Was it specific news?
It didn't seem tied to any single piece of news, more likely a cascade effect driven by leverage. The sell-off triggered a wave of forced liquidations. Over $449 million worth of long positions were liquidated across major exchanges in a short period.
Wow, nearly $500 million wiped out.
Yeah, these are leveraged bets being automatically closed out as prices fall, which then adds more selling pressure, causing prices to fall further, triggering more liquidations. It's a vicious cycle common in highly leveraged markets.
And where did the price end up?
That cascade pushed the price of Bitcoin back down below $109,000 by the end of the weekend. So a very sharp reversal, wiping out all the post-Fed gains and then some.
What does that tell us about the crypto market right now?
It signals that despite the narrative around increasing institutional adoption through ETFs, the underlying market structure remains fragile and extremely sensitive to these leverage dynamics and margin calls. A sudden shift in sentiment or flow can still trigger very large, rapid price swings due to this forced selling. It's not behaving like a mature, stable asset class just yet.
Okay, so summing up the market reaction, we have a fragile, high-flying, narrowly led stock market, a deeply skeptical bond market pushing back against the Fed's dovishness, and this bizarre, contradictory, simultaneous rally in gold, and the dollar signaling profound confusion.
That's a pretty good summary of a complex week.
And all of it, every single one of those dynamics, points to the absolute necessity of looking forward to the data. The market is desperately seeking clarity. So let's step directly into the main event, the data gauntlet awaiting us this week, September 29th through October 3rd.
Right, the calendar is absolutely packed this week, requiring intense focus from anyone managing money or making decisions. But while there are several important releases, everything undeniably builds towards one single moment: Jobs Friday.
Friday morning, 8:30 a.m. Eastern Time. That's when we get the September non-farm payrolls NFP report from the Bureau of Labor Statistics.
That's the one. This report is the ultimate test, the validation point, or potentially the harsh challenge to the Fed's entire insurance cut narrative, which, as we established, was predicated almost entirely on their revised view of a cooling labor market.
So this number will tell us if their justification holds water based on the most recent actual data.
In large part, yes. It's the most comprehensive and timely look we get at the health of the job market.
Okay, so what are the specific expectations? What is the market consensus forecast for September payrolls? And maybe more importantly, why is that consensus forecast so incredibly low this time around?
The median consensus forecast among economists calls for a truly meager net gain of just 39,000 jobs in September.
39,000, that's barely anything. That's like a rounding error sometimes.
It's incredibly low. For context, job growth needs to be somewhere around 75,000 to 100,000 per month, just to keep pace with the natural growth of the working age population. So 39K is well below the level needed to hold the unemployment rate steady, theoretically.
And the unemployment rate forecast?
The consensus expects the unemployment rate to hold steady at 4.3%, maybe reflecting some labor force participation shifts offsetting the weak job growth. Average hourly earnings are expected to show continued moderation as well.
But why the 39K? Why is the consensus so dramatically low? Is it just based on that weak August number?
It's not just August. Analysts are now actively integrating those massive historical downward benchmark revisions. that potential 911,000 overstatement through March 2025 directly into their forecasting models.
Ah, so they're assuming the revised weaker trend is the true starting point now.
Exactly. They're essentially saying if the BLS revisions are correct and the job market was much weaker historically than we thought, then that weak trend likely continued into September. A 39,000 print, being barely enough to keep pace with population growth, would fit that narrative perfectly.
So if the number comes in right around that 39K consensus,
If it lands right there, or even slightly below, it would unequivocally validate the Fed's dovish narrative. It would confirm their assessment that the labor market slowing is real, it's rapid, and their insurance cut was not only justified but possibly necessary.
okay, that's the validation scenario. But you keep stressing that the risk profile around this report is asymmetrical. What does that mean practically for the listener trying to plan their positioning or reaction for Friday? How do we quantify that specific risk?
Asymmetry here means that the potential market reaction is not balanced. The greatest threat to market stability, the biggest potential negative shock, comes from a surprisingly strong report, not a weak one.
Why is strong data the bigger risk right now? Usually strong data is good news.
Normally, yes. But not when the market and the central bank have just anchored policy decisions and market pricing firmly to a narrative of a cooling labor market.
Heh.
If we suddenly get a jobs number significantly above that very low 39,000 consensus,
Like, what kind of number would be considered surprisingly strong?
I'd say anything definitively above 100,000 would start raising serious questions. If it came in closer to, say, 150,000 or higher, especially if it was coupled with average hourly earnings accelerating again instead of moderating.
Okay, what happens then?
That scenario directly contradicts the entire rationale for the Fed's insurance cut. It would imply the Fed acted preemptively based on potentially outdated historical revisions, while the current labor market might actually be reaccelerating or at least proving much more resilient than they believed.
And the market reaction to that contradiction.
You would likely be immediate and sharp. You'd probably see an instant, significant spike in Treasury yields, maybe 10 to 15 basis points on the two-year yield, within minutes of the release.
Wow, that's a huge move.
It is. Because the market would instantly start pricing out those additional Fed cuts the dot plot suggested, maybe even start contemplating if the next move could eventually be a hike again, though that's further out.
And stocks, particularly those tech stocks that led the rally.
They would likely get hit hard. NASDAQ futures could easily fall, say, 3% to 5% almost immediately on a surprisingly strong number. Why? Because the higher rate expectations would hammer the valuations of those long-duration growth stocks. The market simply cannot easily handle the cognitive dissonance of the Fed cutting rates based on old data while new data screams strength.
So the potential downside, the market disruption from an unexpectedly strong report, is vastly greater than the potential upside from a weak report, which would largely just confirm the existing narrative and maybe extend the rally modestly.
Exactly. The asymmetry is skewed heavily towards negative volatility if the data surprises to the upside. A weak number is almost expected now.
That's a crucial point. So paradoxically, the current bullish camp, the people benefiting from this rally, are actively praying for a weak jobs number on Friday.
It sounds counterintuitive, but yes. In the current context, weak economic data is good news for the market because it validates the Fed's dovish stance and keeps the prospect of lower rates alive.
That is a profound statement about just how dependent this market rally has become on monetary policy expectations rather than perhaps underlying fundamental strength.
It highlights the central role the Fed is playing, absolutely.
Okay, NFP is clearly the main event, the climax with asymmetrical risk, but it's not the only important release this week. What other global growth barometers are critical for us and you, the listener, to monitor in the days leading up to Friday?
We get some really crucial reads on global manufacturing activity, which has been a persistent weak spot. First up, on Tuesday, we get the official China NBS manufacturing PMI.
How important is that one?
Hugely important. Given China's ongoing structural challenges, particularly in the property sector, and broader concerns about slowing global demand for goods, this PMI serves as a crucial real-time proxy for the health of the world's second-largest economy.
What would a weak reading signal?
A weak reading here, say falling further into contractionary territory, below 50, would amplify global growth fears. It could weigh heavily on commodity prices, on multinational companies with significant China exposure, and on sectors sensitive to international trade flows, like shipping and logistics. It sets a global tone.
Okay, so China PMI on Tuesday. Then we get the U.S. equivalent on Wednesday, right? The ISM manufacturing PMI.
Correct. Wednesday morning brings the Institute for Supply Management's manufacturing PMI for the U.S. This is another key gauge, specifically for the U.S. factories sector.
And the expectation there.
The consensus forecast is currently sitting at 49.2.
Still below 50.
Still below that crucial 50-point threshold that separates expansion from contraction. If it hits consensus, it would mark yet another month of the U.S. manufacturing sector being technically in contraction.
Why is this sector still struggling?
It's likely a combination of factors. Lingering effects from previous inventory builds, potentially some impact from ongoing tariff concerns and trade tensions, and just generally slowing global demand for physical goods as consumers perhaps shift spending back towards services post-pandemic. This release will be vital for understanding if U.S. factory activity is stabilizing, worsening, or maybe showing nascent signs of recovery.
Any other central banks meeting this week?
Yes, we also have monetary policy decisions coming from the Reserve Bank of Australia, RBA, and the Reserve Bank of India, RBI.
Any changes expected there?
The broad consensus is that both the RBA and RDI are expected to hold their policy rates steady at their current levels. This would further reinforce that theme of global policy divergence we discussed earlier. Some cutting, some holding, the BOJ potentially tightening. It's not a synchronized global cycle right now.
Okay, so NFT Friday, China PMI Tuesday, US ISM Wednesday, RBI holding. That's a lot. Finally, before we move to the corporate earnings, we absolutely must put this data flood into its proper historical context. We just finished September.
Yes, and September's strong market performance was, frankly, highly anomalous.
How so?
Historically, statistically, September is usually the weakest month of the calendar year for U.S. stock market returns. So the fact that the S&P 500 rallied to new highs was unusual against that seasonal headwind.
But now we're flipping the calendar to October.
And now we are entering October. And you, as an investor, absolutely must be aware that October carries a very different and, frankly, more dangerous historical reputation.
The reputation for volatility.
Exactly. October is, historically speaking, the single most volatile month of the year for the U.S. stock market. It's famous for sharp swings, sudden market dislocations, and even major crashes like 1929, 1987.
You don't need to remind us of those. But how much higher is the volatility risk statistically? Is it a small difference or significant?
It's quite significant. Analysis, for example, from firms like Goldman Sachs consistently shows that equity market volatility, measured by things like the standard deviation of daily returns, is on average over 25% higher in October compared to the average of all the other months.
25% higher. That's substantial.
It is. And this elevated risk isn't just random noise. Analysts believe it's a structural phenomenon linked to a confluence of factors that often converge in October.
What kind of factors?
Well, you have intense pressures surrounding the release of third-quarter corporate earnings reports, which often start in mid-October. You have large institutional funds potentially making significant portfolio adjustments as they approach year-end for performance benchmarking. And as we've just laid out, you also have a very dense macroeconomic calendar in October, making every data point a potential catalyst for sharp market reaction. All these things tend to collide this month.
And we should probably add one more potential lurking risk, even if the market seems to be ignoring it for now.
You're thinking of the potential for a U.S. government shutdown.
Exactly. Funding deadlines are approaching again. The political situation remains contentious. It's a non-zero risk that could suddenly erupt and compound market anxiety, especially if the economic data starts to disappoint.
It's definitely a background risk factor that shouldn't be completely dismissed, even if it's not the market's main focus right now. It adds another layer to October's potential for disruption.
Okay, so the macro calendar provides that top-down pressure, the potential for volatility. But to get the full picture, we need the bottom-up view as well. Corporate earnings give us that necessary granular perspective on economic reality. Let's shift our focus now to the micro view and the key earnings reports to watch this week. All right, kicking off the earnings calendar early in the week, we get a really critical health check on a key part of the consumer economy discretionary spending, specifically on services. That comes from Carnival Corporation, CCL, the cruise line giant, reporting before the market opens on Monday.
Yeah, Carnival's report is always a fascinating one because it gives us such a direct read on whether consumers are still willing and able to spend big bucks on experiences like travel and leisure.
Especially after the huge post-pandemic boom in travel. Is that demand holding up?
That's the key question. The headline numbers for Carnival are actually expected to look pretty strong, reflecting that continued demand. Consensus EPS is around $1.32, which is solid, but experienced investors know to look past the headline EPS with companies like Carnival.
So what are the crucial underlying metrics we need to watch?
There are three key operational metrics that really signal the forward momentum and pricing power of the business. First is net yields.
Net yields. What does that measure?
It essentially reflects the revenue generated per available passenger cruise day after accounting for certain costs. It's a direct read on their ability to raise ticket prices and onboard spending. The forecast is for around $247.71. We need to see if they can meet or beat that, showing pricing power is intact.
Okay, net yields for pricing power. What's second?
Second is occupancy rates. How full are the ships? The forecast is for a super high 112.2%.
Over 100%. How does that work?
It means they have more than 2 people per cabin on average. Think families with kids sharing a room. Hitting that high occupancy level is crucial for profitability.
Got it. And the third key metric?
The third, and arguably the most important leading indicator, is customer deposits. This is money paid in advance for future cruises.
Ah, so it shows the booking pipeline.
Exactly. Last quarter, Carnival reported a record $8.5 billion in customer deposits. That number serves as an excellent forward indicator of demand strength for the next 6 to 12 months. We absolutely need to monitor whether that deposit growth stalled, held steady, or continued to accelerate in the latest quarter. If deposit growth slows significantly, it could be an early warning sign that the big travel boom is finally starting to peak.
Okay, Carnival on Monday for the service travel consumer. Then we swing to the other side of the consumer coin on Tuesday afternoon with Nike and Katie reporting after the market closes.
Yes, Nike, arguably the biggest global consumer bellwether we have. Their results offer insights not just into athletic apparel and footwear, but also broader retail health, global consumer sentiment, and those persistent inventory issues that have plagued the retail sector.
And expectations for Nike's quarter are not great, right?
Not great at all. Nike's fiscal first quarter is expected to be exceptionally challenging. The consensus forecast calls for a massive year-over-year earnings per share, EPS, plummets down 62.9% to just $0.26 per share.
Wow, a nearly 63% drop in earnings. What's driving that?
It tells you that this current quarter for Nike is much less about strong sales performance and much more about the painful process of restructuring, clearing out excess inventory that built up post-pandemic, and likely heavy promotional activity to move that product. That inventory bloat has been a major headwind for Nike and its peers.
So if the current quarter's results are expected to be that bad, where should investors focus their attention?
Given that difficult outlook is already largely baked into expectations, the focus shifts almost entirely to forward guidance. What does Nike see for the rest of its fiscal year?
What specifically within the guidance?
Investors will be scrutinizing management's commentary on their progress in reducing those inventory levels. Are they making headway? But crucially, are they doing it without completely gutting their gross profit margins through excessive discounting? That's a delicate balancing act.
It really is. And geographically, are there specific regions we should pay close attention to in Nike's report?
Absolutely. 2 regions are key. First, demand trends in their home market of North America. Are U.S. consumers still buying premium sneakers and apparel, or are they trading down? Second, their progress in Greater China.
China's been a challenge for them recently, hasn't it?
It has. It's been a source of volatility, impacted by slower overall retail traffic, intense competition from strong local Chinese brands, and shifting consumer preferences. Hearing positive commentary on China would be a significant boost.
And what about their sales channels?
Yes, that's the other big strategic focus. Management commentary on how successfully they are transitioning towards their direct-to-consumer DTC strategy, selling through their own website and stores, versus relying on traditional wholesale retail partners like Foot Locker, will be a key signal for the future profitability profile of Nike and, frankly, the entire athletic apparel industry.
Okay, so Carnival and Nike giving us critical but potentially divergent views on the consumer. While the consumer is sorting itself out, we also need an early look at the health of Wall Street itself, the financial sector, capital markets activity. Where do we get that?
We get a very useful early read from Jefferies Financial Group, JEF, which reports its quarterly results on Monday afternoon after the market close.
Why is Jefferies considered an early bellwether for the broader financial sector? They're not one of the giant bulge bracket banks.
They're not, but they have a significant investment banking and capital markets business. And crucially, their fiscal quarter ends a month earlier than the big banks like JP Morgan, Goldman Sachs, etc. So their results give us a valuable preview of the trends that likely played out across the industry during the period.
Okay, so what specific divisions or data points will investors be focusing on in Jeffrey's report to gauge the health of the deal market and trading?
The primary focus will be squarely on their investment banking division. Investors will be looking for signs of a meaningful rebound in advisory revenues, which come from M&A advice.
Mergers and acquisitions.
Right. And also underwriting revenues, which come from helping companies issue new stocks and bonds.
Has that activity been slow?
Extremely slow. Deal-making activity, both M&A and IPO's follow-on offerings, was largely frozen during the period of rapidly rising interest rates and economic uncertainty over the past 18 months.
So a pickup at Jeffrey's would be a good sign.
A solid performance in Jeffrey's investment banking unit would be a very positive signal that this deal drought might finally be ending. It would suggest that corporations and private equity firms are regaining confidence to pursue transactions now that Fed policy is perceived to be pivoting.
What kind of detail might they provide?
Analysts will be listening closely for management commentary. On the M&A pipeline, are conversations picking up? Are deals getting closer to announcement? Especially in specific industries that tend to lead recoveries, like maybe smaller private equity bolt-on acquisitions, or specific areas like technology consolidation or energy transition deals.
And what about their trading business?
The health of their capital markets division is also important. That gives us a real-time read on overall trading volumes and volatility in both stocks and bonds during the reporting period. It provides context for what we might expect when the bigger banks with massive trading desks report their results next month.
Okay, Jeffrey's on Monday for the Wall Street pulse check. Now, moving to what you called the ground level view of the U.S. economy, we have two really fascinating reports on Tuesday morning that seem perfectly timed to give us micro level context right before Friday's big NFP number.
Yes, these two are really valuable for connecting the macro dots. We have Paychex, PAYX, and Lamb Weston, LW, both reporting before the bell on Tuesday.
Let's start with Paychex. Why is PAYX indispensable for understanding the labor market?
Because Paychex is one of the largest providers of payroll processing, HR, and benefits outsourcing services, primarily for small and mid-sized businesses, SMBs, across the United States.
So they see firsthand what's happening with hiring and wages at the small companies that are the real engine of job creation, far away from the headlines about layoffs at giant tech firms.
Exactly. They have a direct, real-time pulse on the segment of the economy that actually employs a majority of Americans, so their results and commentary cut through the noise of government statistics.
What specific metrics should we watch in the Paychex report?
We'll be looking at revenue growth in their core management solutions segment, which includes payroll services. We also watch the number of worksite employees covered by their professional employer organization, or PEO division. That's where they essentially act as the outsourced HR department for clients. Growth trends there reflect underlying hiring activity.
What you said, the commentary is key.
Crucially, yes. The real gold standard from the Paychex report isn't just the quantitative results, it's the qualitative management commentary on their earnings call. What are their leaders hearing directly from their thousands of SMB clients across different industries and regions?
What kind of insights?
Insights on actual hiring trends. Are clients actively adding staff, freezing hiring, or laying people off? What about wage pressures? Are they still having to bid aggressively for workers? Or is wage growth finally cooling down at the ground level? This qualitative color provides invaluable context for interpreting Friday's big, backward-looking NFP report. If Paychex executives say their clients slammed the brakes on hiring in September, it strongly validates the Fed's cut. If they say hiring remains surprisingly resilient, it challenges it.
Okay, Paychex for the SMB labor pulse. And then the essential, but maybe often overlooked, report from Lamb Weston, LW. What do they tell us?
Lamb Weston is one of the world's largest producers of frozen potato products. Think French fries for restaurants, frozen potatoes for grocery stores. Their report gives us a pure, unadulterated read on margin pressures facing food producers, and by extension, trends in food inflation and food service demand.
And expectations are tough for them, too?
Yes, they're expected to report a significant earnings decline. Consensus is for about a 26% year-over-year fall in EPS.
Why the big drop?
The earnings call commentary will be key here. We need to understand the persistence of input cost inflation. Are costs for key inputs like labor, transportation, cooking oils, and raw potatoes still elevated or finally easing? What about the competitive pricing environment? Can they pass higher costs onto their customers, or are they facing pushback?
And what about demand?
Exactly. Their commentary on demand trends from their major restaurant clients, think large fast food chains. Casual dining serves as an excellent proxy for foot traffic and overall health across the entire food service industry. Are restaurants ordering robustly, or are they cutting back due to slowing consumer traffic? Lamb Weston connects the dots between farm costs, producer margins, and consumer behavior at restaurants.
Wow. So paychecks and Lim Weston really are that connective tissue between the high-level macro narrative and the on-the-ground corporate reality.
Absolutely. They provide crucial verification, or contradiction, of the broader economic themes playing out.
Okay, this is fantastic context. We have the Fed's implicit blessing in the form of that insurance cut. We have the technical momentum carrying equities higher, albeit narrowly. But as you said, that permission slip from the Fed is now being held up directly against the harsh light of economic reality presented by this data gauntlet and these earnings reports this week.
The moment of truth is approaching.
It really is. So it's time for us to synthesize all of this and offer some concluding insights and actionable recommendations for you, the listener, trying to navigate this incredibly high-stakes period.
Okay, let's pull it all together. The market clearly stands at a critical inflection point right now. The Federal Reserve's decision to deliver that insurance cut definitely provided a supportive policy tailwind that helped push stocks to new highs last week.
Gave the market the green light, in a sense.
It did. But, and this is the crucial but we keep coming back to, that policy decision was fundamentally justified, according to the Fed itself, by their reassessment of historical labor data, which showed significant prior cooling.
Based on the revisions.
Based on those benchmark revisions. Now, the flood of current economic data we received this week, culminating in that high-stakes non-farm payrolls report on Friday, will essentially render the final verdict, or at least the next important judgment, on the validity of the central bank's cautious, preemptive stance. Was their reading of the tea leaves correct?
The data this week either confirms their view or strongly challenges it. So, to help everyone prepare specifically for Friday's NFP release, let's quickly revisit those three primary scenarios we discussed and detail the most likely market reaction in each case. This is crucial for planning.
Absolutely. Let's lay them out clearly. Scenario 1. Weak data, the Fed is right. This is the outcome where the September payroll gain comes in weak, let's say below 50,000 net jobs added, and ideally it's coupled with flat or even falling wage growth metrics.
What happens then?
This outcome directly confirms the narrative that the labor market is structurally slowing down, just as the historical revisions suggested. The expected market response is likely a powerful continuation of the recent risk-on rally. You'd expect bond yields to fall further, the U.S. dollar to weaken, and leadership to remain firmly with those duration-sensitive technology and growth stocks that benefit most from lower rate expectations. This is probably the path of least resistance for the current market trend.
Okay, weak data rally continues. Now, scenario 2.
Scenario 2. Strong data, the Fed is wrong. This is the scenario we flagged as the most disruptive, carrying the highest asymmetrical risk for markets right now. Here, we're looking at a payroll gain that significantly beats expectations. Let's use the benchmark of clearly about 100,000 jobs added, and critically, it's accompanied by signs of accelerating wage pressures, not moderating ones.
The nightmare scenario for the Fed's narrative.
Precisely. This outcome directly challenges the entire foundation upon which the insurance cut was built. It suggests the Fed might have jumped the gun based on old data. The market response here would likely be swift and potentially quite painful.
Describe painful.
A sharp, immediate rise in bond yields across the curve, a significantly stronger U.S. dollar, fueled by the market rapidly repricing Fed expectations much higher. And, most relevant for many portfolios, a significant correction, potentially 5% or more quickly, in those mega-cap technology names that have led the rally and are most vulnerable to rising rate expectations. This is the scenario that could trigger a real bout of volatility.
Got it. Strong data, sharp sell-off, especially in tech. What's the middle ground? Scenario 3.
And scenario 3, muddled data Goldilocks of sorts.
Yeah.
This is where the payroll gain lands somewhere in that moderate middle range, let's say between 50,000 and 90,000 jobs. And importantly, it's combined with wage growth that continues to moderate or stay stable, not accelerate.
So not great, not terrible.
Exactly. This kind of print would likely create some initial volatility and confusion as the market digests it. Is it weak enough? Is it too strong? But ultimately, it would probably be viewed as constructive overall.
Why constructive?
Because the data wouldn't be weak enough to stoke immediate, widespread recession fears, but it also wouldn't be strong enough to force the Fed to immediately slam the brakes on its easing bias or signal a policy reversal. It keeps the hope of future cuts alive without confirming imminent economic collapse. In this scenario, a buy-the-dip mentality would likely prevail after the initial churn as investors settle back into the ambiguity, perhaps favoring a broader range of stocks.
Okay, those three scenarios, weak Fed right, strong Fed wrong, muddled Goldilocks, provide a great framework for thinking about Friday. Given this critical NFP asymmetry, the potential for scenario 2 disruption, and the historical volatility we know comes with October, what are the practical, actionable takeaways for you, the listener, trying to manage a portfolio through this week?
Okay, let's break it down into a few key areas. First, regarding asset allocation, you have to acknowledge the technical momentum. The S&P 500 did find support at its 20-day moving average last week and pushed to new highs. That warrants maintaining a core allocation to U.S. equities for now.
Don't fight the tape completely.
Don't fight the tape completely, but be smart about it. Given the narrow leadership and the risks we've outlined, prudence suggests considering increasing exposure to some of the undervalued sectors that have severely lagged this year and could offer diversification benefits.
Such as?
Think about areas like healthcare, XLV, and potentially energy, XLE, depending on your view on oil prices. These sectors are less correlated with the mega-cap tech trade and could act as effective relative hedges against a potential rotation out of those overstretched tech stocks, particularly if scenario 2, strong data, rising rates, unfolds.
What about small caps and value?
Definitely keep a close watch on the tentative outperformance we saw last week in small cap stocks, IWM, and potentially broader value factors, VTV. If this week's data, especially NFP, comes in weak, scenario 1, and confirms the Fed's dovish view, that nascent rotation away from just mega cap growth could gain legs and become a more significant durable trend into year-end. So, positioning for that possibility makes sense.
Okay, so core equity, but consider adding defensive values, small cap hedges, or tilts. What about specific risk management tools?
Risk management is absolutely paramount this week. Given the known historical volatility pattern of October and, more acutely, the asymmetrical risk profile inherent in Friday's NFP report, employing some tactical risk management strategies seems highly prudent.
What does that look like in practice?
For sophisticated investors, it could mean considering portfolio hedges. For example, buying targeted put options on the major indices, perhaps specifically the NASDAQ 100, QQQ, which is arguably the most vulnerable index in that disruptive scenario 2 where rates spike.
Using options to define downside risk.
That's exactly. Alternatively, for those less comfortable with options, it could mean increasing allocations to assets that tend to perform well, or at least hold their value better, in environments with falling real yields or heightened uncertainty. Gold, GLD, is the obvious candidate here, especially if you believe scenario 1, weak data validating the Fed, is the more likely outcome. Gold benefits if the Fed's dovishness is confirmed. Cash is also a valid tactical position in times of high uncertainty.
Okay, asset allocation tilts and specific risk hedges. Finally, let's connect the incoming data and earnings back to specific sectors. Which sectors should we be focusing on this week for trading cues or signs of confirmation contradiction?
I'd highlight 3 key areas where the data and earnings intersect directly. First, financials, XLF. Their direction this week will likely be heavily influenced by the Jefferies earnings report early on, but more importantly, by the ultimate direction of Treasury yields after the NFP report. Remember, banks generally benefit from a steeper yield curve, which could happen if longer-term yields rise faster than short-term yields, or if rates rise overall in scenario 2. So financials are very sensitive to the outcome here.
Okay, financials tied to yields.
Second, consumer discretionary, XLY. This sector's fate hangs heavily on the forward guidance provided by both Carnival Service Travel and Nike Goods Retail. The key questions: is the high-end consumer still splurging on experiences? And is the global retail inventory overhang truly resolving without crushing margins? Those earnings reports provide crucial clues for the whole sector. And third, industrials, XLI, and materials, XLB. These more cyclically sensitive sectors will be highly reactive to the global PMI data points we get, particularly that official manufacturing report coming out of China on Tuesday and the U.S. ISM manufacturing on Wednesday. Weakness there would likely weigh heavily on these sectors as it signals slowing global demand for core industrial goods and basic materials.
Excellent. Financials, consumer discretionary, industrials, materials, key sectors to watch based on this week's specific catalysts.
Right. So this has been a really comprehensive breakdown, I hope, of what is undeniably shaping up to be a very high-stakes week for markets. We've got this technically bullish backdrop. The market was given a temporary permission slip, if you will, by the Fed's insurance cut.
Permission to rally.
Permission to continue rallying. But that permission slip is now being held up directly against the often harsh light of economic reality, as revealed by the data gauntlet and the corporate earnings reports coming our way. The market needs validation, and this week will provide a big dose of it one way or another.
And that leads us perfectly into our final provocative thought for you, the listener, to really consider as you navigate not just this week, but the coming months.
What's on your mind?
It feels like the era of clear, reliable, unambiguous forward guidance from central banks, particularly the Federal Reserve, might be fundamentally over or at least significantly diminished for the foreseeable future.
That's a bold statement. Why do you say that?
Because the Fed's insurance cut last week, justified by those backward-looking revisions, was almost an explicit moment of confidence from them in their own ability to read the subtle shifts and steer the economy preemptively. They essentially said, trust us, we see something in the revised data that justifies acting now, even if the current data isn't screaming recession.
Okay, a moment of Fed confidence in their own forecasting, perhaps.
Right. But the implication for you, the investor, is profound. You must now be prepared to rely much more heavily on the incoming data itself, and perhaps less on the central bank's interpretation or guidance about that data. The market's reaction last week, especially in the bond market, showed skepticism toward the Fed's narrative almost immediately.
So, trust the data more than the dots.
Perhaps, or at least verify the Fed's narrative against the data independently. The ultimate question, the one that will likely define market performance for the rest of this year and into next, is this. Did the Federal Reserve, using those historical labor data revisions, correctly identify the true economic pivot point back in September? Or was there preemptive action based on what might turn out to be old news historical data that will soon be contradicted by a surprisingly resilient or even re-accelerating present, as hinted at by some of last week's data?
And if that second possibility turns out to be true?
If the Fed acted on old news and the current economy is stronger than they thought, it could force them into a rapid, potentially disruptive policy reversal, or at least a significant pause in their easing plans, much sooner than the market currently expects.
That would certainly challenge the current market narrative.
Absolutely. This week, starting with the PMIs and culminating with NFP, begins the crucial process of answering that question. You, the listener, must pay close attention, analyze the data objectively, and react with discipline and agility to whatever reality the numbers reveal.
Sound advice for a pivotal week. Thank you for joining us for this deep dive.